The Federal Reserve's expanding balance sheet. What it means for your portfolio. Something unusual happened last quarter that most investors missed. The Federal Reserve purchased nearly $100 billion in Treasury securities over an 8-week period, marking the first significant expansion of their balance sheet in over 2 years. Wall Street analysts called it a technical adjustment. The Treasury Secretary pointed to reduced bond volatility as evidence of stability. But if you look beyond the headlines, this shift reveals something more fundamental about where we are in the economic cycle. Let me be clear from the start. This is not about predicting financial collapse or claiming the sky is falling. This is about recognizing a pattern that has repeated throughout economic history and positioning yourself accordingly. The balance sheet challenge. Nobody's talking about here is the context most people do not have. After the 2020 crisis response, the Federal Reserve's balance sheet peaked at $9 trillion. They committed to quantitative tightening, reducing that figure systematically. They made it down to $6.5 trillion before conditions forced them to pause and now reverse course. Think about what that means. They could only reduce their balance sheet by $2.5 trillion before the system started showing stress. Compare that to 2008, when their entire balance sheet was under $900 billion, and you start to see the structural change in how our financial system operates. The Fed and major financial institutions will tell you this recent Treasury buying is different from quantitative easing because it involves short-term securities and serves technical purposes. They're not technically wrong, but they're missing the bigger picture. When your financial system requires ongoing central bank intervention to maintain stability, you're not operating from a position of strength. You're managing chronic fragility that could become acute under the right conditions. The real concern: what's coming next? The immediate $100 billion matters less than what's on the horizon. Over the next 12 months, approximately $9 trillion in U.S. debt needs to be rolled over or refinanced at current interest rates. Add another $2 trillion in new borrowing, and you're looking at $11 trillion that needs buyers. Who's stepping up? China has been a net seller for several quarters. Japan, traditionally the largest foreign holder of U.S. debt, is seeing capital return home as their own interest rates normalize. Foreign appetite for U.S. Treasuries is declining across the board. This creates a fundamental question. If foreign central banks aren't buying and the private sector can't absorb the full amount, who fills the gap? History suggests the Federal Reserve will need to play a larger role, whether they call it quantitative easing or something else. When that happens, it has implications for everyone holding dollar-denominated assets. Understanding currency dilution. When you increase the supply of any currency without corresponding economic productivity, you dilute purchasing power. It's mathematical, not political. You can see this in daily life. 5 years ago, $50 bought a week's groceries. Today, it covers 2 days. A fast food meal that cost $7 now costs $13. Median home prices have risen faster than wages for 3 decades. Official inflation metrics show 3 to 4% annually, but alternative calculations using older methodologies suggest the real number is higher. Why smart money is moving central banks globally have been net buyers of gold for 15 consecutive years, purchasing over 1,000 metric tons in 2023 alone. Gold serves as the ultimate reserve asset with no counterparty risk. It can't be printed, diluted, or defaulted on. Industrial demand adds another driver. Modern technology runs on precious metals. Every smartphone contains gold and silver. The renewable energy transition is particularly metal-intensive. A single electric vehicle uses 3 times as much copper as a conventional car, while solar panels rely heavily on silver. Mining production has been flat for a decade, while industrial applications have exploded. The AI revolution, requiring massive data centers with advanced chips, accelerates this trend. 3 possible paths forward. Let's think through where this leads. The Federal Reserve essentially faces 3 options, though only one is politically viable. Option 1. They could raise interest rates aggressively and refuse to monetize government debt. This would restore sound money principles but trigger an immediate recession, possibly a severe one. Housing markets would collapse, unemployment would spike, and the political backlash would be intense. This option, while theoretically correct, is practically impossible. Option 2, they continue on the current path, managing the system through periodic intervention while trying to minimize visible inflation. This is the most likely scenario. It means continued currency debasement, but at a managed pace. Your savings lose value gradually rather than suddenly. Option 3, a more dramatic restructuring, possibly involving digital currencies or other monetary reforms. This is the long-term wildcard that becomes more likely if Option 2 fails to contain the problem. Understanding which scenario is unfolding helps you position accordingly. Practical steps for protection. Holding 100% of your wealth in depreciating currency is unwise. A balanced approach means diversification into assets that maintain purchasing power during inflation, historically including real estate, commodities, and precious metals. Precious metals offer liquid, globally recognized assets with no counterparty risk that have preserved wealth across every currency crisis in recorded history. They're not about getting rich, but about protecting what you have. The premiums on physical gold and silver, the gap between spot prices and purchase prices, indicate supply constraints and strong demand. Extended delivery times signal the market is tighter than paper prices suggest. The bottom-line economic systems built on ever-increasing debt eventually face a reckoning, not because of moral failure, but because mathematics has its own logic. The question isn't whether adjustments happen, but how and when they unfold. You can choose to be proactive or reactive. Most people wait until the crisis is obvious, then wonder why their options have narrowed and their choices are limited. I'm not here to create panic. I'm here to present data and let you draw your own conclusions. Study the patterns yourself. Look at the Fed's balance sheet trajectory over the past 5 years. Look at foreign Treasury holdings and how they've shifted. Look at central bank gold purchases and ask yourself what they know that retail investors don't. Then decide what makes sense for your specific situation and risk tolerance. Whatever you choose, make it a deliberate choice based on information, not a passive default based on inertia or hope. The best time to prepare for volatility is before it arrives, when you can think clearly and act methodically. Don't wait for confirmation from mainstream sources or official declarations. By then, everyone else is competing for the same exits, and the best opportunities have already closed. Stay informed, stay rational, and protect what you've worked hard to build.